Welcome to another deep dive. We're all about getting to the heart of things. Really cutting through the noise and giving you the insights that matter without the overwhelm. It's like an express lane to being in the know.
Yeah, think of it as knowledge that really sticks with you.
So today we're tackling financial statements. Our trusty guide for this adventure is Thomas Edelson's Financial Statements. It's a step-by-step guide to, understanding and creating financial reports. This book consistently gets rave reviews for breaking down what can seem like a really dry topic, especially for those just starting out in business or those running their own ventures.
What's great about this book is that Edelson takes this complex accounting world and turns it into something that's really quite approachable.
Exactly. We're going to dig into the structure and the language of financial statements, starting with the very basics and then venturing into some, I think, surprisingly interesting areas.
Oh, yeah, and I think you're going to be surprised by how interesting this all is.
We're aiming to build you up, give you a solid foundation so you can navigate this whole world of finances with confidence, without feeling lost in all the jargon.
And even though we're dealing with numbers, get ready for some aha moments. You might just discover how these statements can tell a really compelling story about a business's financial health.
All right, let's unpack this. Our first stop: structure and vocabulary. Accounting can feel a bit like learning a whole new language.
Right.
And a lot of that comes down to the specific terms they use and a few simple frameworks.
Definitely. Once you get comfortable with those terms, the complexity really starts to fade away.
Let's tackle some of those key terms that can be real stumbling blocks. For example, sales and revenue. Now, in everyday conversation, these might seem a bit different. But in accounting, they're essentially the same thing. Edelson calls it the top line. Exactly. It's that total amount of money that a company brings in from selling its products or services. And similarly, profits, earnings, and income, those are all interchangeable too. These are the bottom line. What's left after all those costs and expenses are paid.
So, top line money in, bottom line what's left.
Yeah.
Pretty simple, right? Now, this is where it gets really interesting. What about the difference between sales, orders, and shipments? I mean, they're all kind of related in the mind of a consumer, but do they mean the same thing when we're talking about business financials?
This is a super important distinction. So an order is simply a request from a customer saying, hey, I want to buy this. But it doesn't hit the financial statements until the goods are actually shipped or services are actually provided.
Right.
Only then does a shipment turn into a sale. So in accounting speak, the recorded sale happens when, like I said, goods are shipped or the service is provided. It's about when the company has delivered, not just when someone's expressed interest.
So it's all about that moment when the company's actually earned that money, not just when they've got a potential sale in the pipeline.
Precisely.
Okay, so what about profit versus cash? These two sound like they should be pretty much the same thing, right?
Not quite. A company can appear very profitable on paper. Their income statement might look great, but they can still have some serious cash flow problems.
Oh, interesting.
You see, profitability just means that your revenue is exceeding your expenses over a certain period.
Right.
Solvency, however, means that you've got enough liquid cash on hand to pay your immediate bills. So imagine you're making a ton of sales,
Yeah.
but your customers are slow to pay up. You might not actually have the cash flow to cover your own expenses, even though, on paper, you're making a profit.
Wow. A profitable but insolvent company. That sounds like a very precarious situation.
It is. It is. You're walking a very fine line.
Okay, what about costs and expenses versus expenditures? Those
Yeah.
sound very similar.
Yeah, these are often used interchangeably, but there is a subtle difference. Costs and expenses represent what a company has used up in the process of generating revenue.
Okay.
They become expenditures when the company actually pays cash for those things. So think of it like, you use electricity all month, and then you pay the bill at the end of the month.
Right.
The use of electricity is the cost or expense. The actual payment of the bill is the expenditure.
Okay, got it. So it's the timing of that actual cash leaving the company.
Exactly.
Now that we've sorted out some of those key terms, let's turn our attention to the three main financial statements. These are the documents where all these numbers actually come to life.
Yes, the balance sheet, the income statement, and the cash flow statement. It's like having three different lenses through which you can view a company's financial health. What's really cool here is that while each statement gives you a snapshot, it's when you look at them all together that you start to see a really dynamic movie of how everything's working.
It's that interplay, right?
Exactly.
Okay, let's start with the balance sheet. As Edelson puts it, it's a snapshot of what you own and what you owe at a specific point in time. So we're talking about assets, liabilities, and equity.
Exactly. Assets are all the valuable things the company owns.
Right.
Liabilities are what the company owes to others, and equity represents the owner's stake in the company. And underpinning all of this is a fundamental equation: assets, liabilities, plus equity. It's got a balance. That's
Right.
why it's called a balance sheet.
That's like that old-fashioned balancing scale, right?
It is.
Kind of both sides even. Okay, so then we've got the income statement. What story does that tell?
The income statement tells you how a company performed financially over a certain period. It could be a month, a quarter, or even a year.
Mm-hmm.
It focuses on the revenue generated and the expenses incurred in generating that revenue. Ultimately, you arrive at the company's net income or profit.
Okay, and finally, the cash flow statement. This one sounds pretty self-explanatory, doesn't it?
It does, and in principle, it is. The cash flow statement tracks the actual inflow and outflow of cash within a company over a specific time period.
Got
Idelson calls it a simple check register for the business. It shows where the cash is coming from, operating activities, investing activities, and financing activities.
Right.
And it also shows you where the cash is going.
It's like following those little cash breadcrumbs, seeing where they lead.
Why is it so important to consider all three of these statements together?
Because each statement gives you a different but interconnected piece of the puzzle. Changes in one statement will almost always impact the others. For instance, the net income from the income statement eventually flows into retained earnings, which is part of equity, on the balance sheet.
Right.
And what happens on the income statement and the balance sheet will directly affect the company's cash flow. It's all connected.
Right, so it's this whole ecosystem, right?
Absolutely. It's not just these separate pieces. All right, Idelson highlights 12 basic principles of accounting. Are there a few of these that are particularly important to grasp right off the bat?
Yes, definitely. Let's start with measurement. Accounting only deals with things that can be measured in dollars and cents. Resources and obligations that can be quantified. This means that even something incredibly valuable, like customer loyalty, won't show up on the balance sheet because its value is just too difficult to measure.
Okay, so even if something's incredibly valuable to a business, if you can't put a specific dollar amount on it, it doesn't officially count on these financial statements.
That's right. What's next? Let's talk about historical cost. This principle says that assets are generally recorded on the balance sheet at their original purchase price, regardless of whether their value has gone up or down since then. Idelson even jokes that this is often the easiest thing to do, even though it might not reflect the current reality. So, for example, a building that was purchased decades ago might be worth a fortune now, but on the books, it's still valued at its original purchase price, minus any depreciation.
Okay, so accounting tends to be a bit backward-looking in that sense. It sticks to those concrete, verifiable numbers.
It does. What else? Oh, materiality. This is a really important one. Accountants focus on information that is significant enough to influence the decisions of someone looking at the financial statements. Now, what's considered material for a small business is going to be completely different for a massive corporation like Apple.
Right, different scales.
It's all relative.
Okay, so don't sweat the small stuff unless, well, you are a very small operation.
Exactly. Exactly. And then we have estimates and judgments. Because businesses are complex, accountants often have to make reasonable estimates. Things like the useful life of an asset for depreciation or how much of their receivables might not be collected.
So you're making an educated guess, but then you have to stick with that method consistently.
Exactly. Consistency is key. Then we have substance over form. This principle states that accountants need to report the economic reality of a transaction, not just its legal form. Idelson puts it very memorably. If it walks like a duck and talks like a duck, it's a duck.
I like that one.
For example, if a company leases a piece of equipment, but the terms are basically like owning it, accounting will treat it as a purchase, not just a rental agreement.
Don't try to dress it up.
No, be truthful. Okay, and then we have the accrual basis of presentation. This is a cornerstone of accounting, and it means that you recognize revenues when they are earned and match those expenses in the period they occurred, regardless of when the actual cash changes hands.
So it's aligning the financial reporting with the actual business activity.
Precisely. So, for example, imagine Appleseed sells a huge order of applesauce to a supermarket chain in December, but they don't get paid until January. Under accrual accounting, Appleseed would recognize that revenue in December, because that's when the sale actually took place.
Right, they delivered the goods.
Exactly. Under cash basis, they wouldn't record it until they got the money in January. Now, Idelson points out that if you hold inventory, like most businesses do, you generally have to use accrual accounting. It provides a much more accurate picture of performance over time because it matches those sales with the related costs of those sales.
Is that matching principle, right?
It is.
Making sure everything lines up.
Yeah.
So who sets all these rules and principles? This seems like a pretty important job.
It is, and in the U.S., that responsibility falls on the FASB, the Financial Accounting Standards Board. They establish what's known as GAAP, Generally Accepted Accounting Principles. You can think of GAAP as the official rule book for accounting. It makes sure everyone's playing by the same rules and that those financial statements are understandable.
Right, so it's that level playing field. GAAP is the official playbook. Now, you mentioned cash basis versus accrual a little bit earlier. Can you talk a bit more about why accrual is the preferred method?
Sure. Idelson compares the cash basis to managing your finances with a cookie jar. Money in, money out. It's simple, but it doesn't really give you a good sense of profitability. Accrual, while a bit more complex, gives a much more comprehensive picture of a company's financial health and performance over time.
All right, so we've got a good grasp of the basic principles, some key vocabulary. Let's move on to Section B, financial statement construction. Time to see how it all comes together.
This is where we get to see those principles in action through a step-by-step example.
Idelson introduces us to Appleseed Enterprises, a hypothetical applesauce company.
I love that name.
Right. And he has us step into the shoes of the CEO, the treasurer, and the CFO all at once.
It's a great way to really grasp the interconnectedness of those roles.
Okay, so let's walk through those initial transactions, which Idelson conveniently labels T1 through T6.
Remember, we're following the logic here, not getting bogged down in all the numbers.
Right. Focus on the concepts. All right, first up, T1, selling stock. Appleseed sells 150,000 shares of common stock at $10 per share, bringing in a cool $1.5 million. What happens on the books?
This transaction increases their cash, an asset. It also increases shareholders' equity, specifically in the form of common stock, and possibly additional paid-in capital. Idelson takes a moment to explain common versus preferred stock here, noting that common stock usually comes with voting rights.
All right, you get to have a say.
And preferred stock might have dividend preferences.
Okay, interesting.
He also mentions par value.
Par value, right. So that's the value assigned to a share of stock, but it doesn't always reflect the actual market value. Idelson calls it more of a legal formality.
Exactly.
Okay, moving on to P2, paying salary and those associated costs. Appleseed shells out $60,000 in salary and incurs $15,000 in related payroll costs, but $10,000 of those costs are unpaid at the end of the period.
Right, so the cash payment reduces the company's cash, and the total cost of $75,000 reduces their retained earnings, which is a component of equity. That unpaid $10,000 becomes a liability called accrued expenses. Idelson provides a nice breakdown here of payroll deductions and employer contributions, so you can see all the moving parts behind a seemingly simple transaction.
It's a lot more than just that take-home pay.
Definitely.
Okay, next up, T3, borrowing money for a new building. Appleseed gets a loan from the bank for $800,000 to finance that new building. What happens now?
This bumps up their cash by $800,000, but it also increases their long-term debt, which is a liability by the same amount. Idelson mentions here that the loan has a 10-year term and a 7% interest rate, setting the stage for future interest expenses.
Oh, so we're starting to see those future implications.
Exactly.
All right, T4, paying for that building. Appleseed uses the borrowed cash plus some of their own to pay $750,000 for the building.
This decreases their cash, of course,
Right.
but it increases their fixed assets on the balance sheet, specifically property, plant, and equipment, in this case, the building, by the same amount.
Okay.
This is also where depreciation comes into play. The cost of that building will be expensed over its useful life, not all at once.
Right, you spread the cost out over time.
Exactly. Because the building is going to provide value for many years, you want to allocate its cost as an expense, depreciation, over those years.
Makes sense. Okay, T5, hiring and paying the administrative and sales staff. Appleseed hires and pays $20,000 to administrative staff and $30,000 to sales staff. So what's the impact here?
Again, this reduces cash, and the salary expenses also reduce retained earnings. However, they're categorized differently on the income statement to reflect those different roles within the company.
Right, administrative expenses versus sales and marketing expenses. Gotta keep those categories straight.
Exactly.
Okay, and last one in this section, T6, paying those pesky payroll taxes and insurance premiums that were accrued earlier. Appleseed pays out $9,000.
This reduces cash, of course, and it also reduces that previously recorded accrued expense, the liability. Remember, because we're using accrual accounting, the income statement was already hit when those initial costs were recorded. So this cash payment just settles that outstanding obligation.
Okay, that gives us a really good picture of how those initial startup transactions get recorded on the books. Now, let's jump ahead to Chapter 7, where Appleseed ventures into the world of manufacturing. Time to make some applesauce.
Now we're getting into the costs associated with actually producing that delicious product.
Let's dig a little deeper into depreciation. Illson describes it as dribbling over time, a portion of a fixed asset's cost through the income statement. I love that analogy.
Yeah, it really paints a picture, doesn't it?
It does. He gives us a depreciation schedule for Appleseed's building, the land, and the machinery. I noticed that land isn't depreciated.
No, because land, unlike buildings and machinery, generally doesn't wear out.
Right. It's there to stay.
It is. Idelson provides the estimated useful lives and the yearly depreciation charges for the building and the machinery, and explains straight-line depreciation, which is the simplest method.
Which is basically just dividing the asset's cost, minus any salvage value, by its estimated useful life to get the annual depreciation expense. Nice and straightforward.
Exactly. Now let's move on to manufacturing costing. Here, Idelson introduces the concept of standard cost. It's basically a predetermined estimate of what it costs to produce one unit based on a planned production volume.
And for Appleseed, their plan is to produce 20,000 cases of applesauce, and that standard cost comes out to be $10.20 per case. What's the benefit of using this standard cost?
It simplifies things a lot. Instead of tracking the actual cost of every single case, you can use this pre-calculated standard cost.
Okay, that streamlines things considerably. Can you walk us through a simplified manufacturing transaction using these standard costs?
Sure. Let's take transaction T12, where they start production, they've got labor costs, and they're moving raw materials into what's called work-in-process inventory. Conceptually, you'd increase the balance of that work-in-process inventory account using the standard cost for materials and labor.
And then as the applesauce is made, it goes from work in process to finished goods inventory.
Exactly. T15 shows this movement. So if 1,000 cases are finished, the finished goods inventory increases by $10,200 using that standard cost of $10.20 per case.
And this standard cost plays a big role when the applesauce is sold, right?
Absolutely. When they sell the applesauce, the cost of those sold cases becomes the cost of goods sold, or COGS, on the income statement. And again, they use that standard cost per case.
Okay, so what if some of that delicious applesauce goes bad or becomes unsellable for some reason?
That's where you have to write down the value of the inventory. Idelson uses transaction T24, the write-off of bad debt, as an example. You adjust the value of your inventory on the balance sheet and take a hit on the income statement.
It's never fun to write things off, is it?
No, it isn't. Now, what about those manufacturing variances that Idelson mentions?
What are those?
Well, it's the difference between the actual costs you incur in production and that standard cost we talked about.
Right.
And these can be favorable, meaning the actual costs are lower than the standard, or unfavorable, meaning they're higher.
Okay.
And significant variances can signal that your initial standard cost estimates were off, and you need to revisit them.
So that standard cost is a living thing.
It is. You got to keep it updated.
Okay, let's move to a sales transaction. This is where the applesauce finally leaves the company and brings in that sweet revenue.
Transactions T22 and T23 illustrate this. We see the applesauce shipped out, invoices sent, payments received, and even sales commissions paid. All of these affect several key accounts: sales revenue, cost of goods sold, gross margin, and of course, cash.
And discounts offered to customers, those will directly impact that revenue number, right?
Absolutely. Discounts reduce the revenue, which ultimately affects that bottom line profit.
Okay, we've seen the product made, we've seen it sold. What about just the day-to-day running of the business? What are some of those administrative tasks and transactions that Idelson covers?
Chapter 10 delves into those necessary administrative functions. We're talking about insurance premiums, mortgage payments, payroll taxes, and payments to suppliers. Those general things that keep the business going.
Okay, and that mortgage payment on that new building, that's got to be a significant recurring expense.
It is, and Idelson differentiates between the principal and interest components of the mortgage payment. The principal payment chips away at the loan balance, which is a liability. The interest payment, however, is an expense on the income statement. It's basically the cost of borrowing that money.
So each payment, you're tackling both the debt itself and the cost of having that debt.
Exactly.
All right, so after all that production, selling, and the day-to-day running of the business, what's the final picture for Appleseed's first year?
Chapter 11 summarizes their performance. It shows us their pre-tax profit and also how they record income taxes payable, which is their obligation to pay taxes on those profits.
So they made a profit, but then Uncle Sam gets his cut.
Exactly.
All right, we've gone through the process of building those financial statements. Now, how do we make sense of all these numbers? How do we analyze them?
That's where the real insights come in. Building the statements is just the first step.
Right. Got to know what those numbers actually mean.
Absolutely. Section C of the book is all about financial statement analysis, and it starts with financial ratios. Idelson really stresses that looking at the relationships between numbers often gives you more insights than just looking at those numbers in isolation.
So it's not just about having $100,000 in cash, but whether that's enough to cover your upcoming bills.
Exactly. Context is everything.
He also talks about common size statements. What are those?
Common size statements are a super useful tool. Basically, you express every line item on the income statement as a percentage of total revenue and every line item on the balance sheet as a percentage of total assets. This makes it much easier to compare a company's performance over different periods or against other companies, even if they're different sizes.
Right, so it levels the playing field.
Exactly.
Idelson then breaks down ratios into 4 main categories: liquidity ratios, asset management ratios, profitability ratios, and leverage ratios.
Let's start with liquidity ratios. What do those tell us?
These ratios are all about a company's ability to pay its short-term debts.
Okay.
Can they cover those upcoming bills? Some examples are the current ratio and the quick ratio. And Idelson points out that being liquid, meaning having enough cash, isn't the same as being profitable. A company could be making a profit, but still face a cash crunch if they can't convert their assets into cash quickly enough.
Right, that's a crucial point. What about those asset management ratios?
Asset management ratios tell you how efficiently a company is using its assets to generate revenue. We're talking about inventory turnover, asset turnover, and receivable days.
Okay, so how well are they managing their resources?
Exactly. And then there are profitability ratios.
What about those?
These are the return-on ratios. They look at how well a company is generating profit relative to its sales, assets, or equity. Key examples include the gross profit margin, return on sales, return on assets, and return on equity.
Those are big ones.
They are. Idelson stresses that these ratios are vital for assessing a company's long-term financial health and sustainability.
Okay, so now for those leverage ratios.
The leverage ratios, sometimes called solvency or gearing ratios, look at how a company is using debt to finance its assets. Examples are the debt-to-equity ratio and the debt ratio. This gets into the concept of leverage, using borrowed money to potentially boost returns, but also taking on more risk.
It's a trade-off.
It is. Now, where do companies find benchmarks for these ratios? Calculating them for your own company is great, but you need context.
That's where competitor comparisons and industry averages come in. Idelson points out that different industries have different typical ratio ranges because their operations, capital needs, and funding sources vary.
Right. You can't compare an applesauce maker to a tech startup using the same benchmarks.
Exactly. It's about apples to apples.
All right, let's move into a potentially more controversial area, Section D, where we talk about alternative accounting policies and the whole issue of cooking the books.
Idelson's very clear here. Cooking the books is not about making legitimate accounting choices. It's about intentionally messing with the numbers, distorting reality, and committing fraud. It's about lying to people who rely on those financial statements.
So it crosses the line from strategy to illegal activity.
Absolutely. It often involves improperly shifting things between the income statement and the balance sheet to misrepresent performance, or even just making up transactions or amounts altogether.
Can you give us a concrete example of how a company might try to cook the books?
Sure. Idelson describes a scenario where a company might try to inflate its balance sheet and make it look like they're more profitable than they are.
Okay, how will they do that?
They might engage in something called a non-economic asset swap.
With that?
Basically, they exchange an asset that's undervalued on their books for a similar asset at market value, and then they book a profit on that sale, even though they might actually end up with less cash. It's a way to manipulate both their profitability and their asset values.
So they're creating this illusion of success.
Exactly. Idelson also mentions that companies sometimes keep 3 different sets of books.
Why would they do that?
Well, it's not always for nefarious reasons. They might have one set of books for external reporting, another for tax purposes, and a third for internal management.
Okay, different purposes.
Right, but it does create an environment where manipulation can happen more easily. And what's really fascinating is how difficult it can be to detect this kind of fraudulent activity from the outside.
Oh, I bet.
Okay, let's shift gears and talk about how this financial knowledge can help businesses plan for the future. Section E focuses on business expansion, specifically strategy, risk, and capital.
This section is all about bridging that gap between understanding past performance and making those crucial decisions about the future.
Looking ahead.
It is. And Idelson emphasizes that understanding your financial position is crucial when developing a strategy for growth. He outlines a hierarchy here: mission, vision, goals, strategies, actions, and tactics.
Can you walk us through that hierarchy? It sounds pretty important.
Absolutely. The mission is the overarching why. Why does this company exist?
Okay, the big picture.
The vision is the what. What does the company want to become?
Okay, the aspiration.
Goals are the specific, measurable objectives they set to achieve that vision.
Right, those stepping stones.
Strategies are the high-level plans for achieving those goals. Actions are the steps they take to implement the strategies. And tactics are the day-to-day activities. So it's a cascade from that big picture all the way down to the details. A nice framework for thinking about that journey. Now, inherent in any plan for the future is risk.
Absolutely. Risk is part of doing business. Idelson defines risk as something that could have a negative impact on the company's goals.
Okay, so those unforeseen bumps in the road.
Exactly. He distinguishes between intrinsic risks, those coming from within the company, and extrinsic risks, those coming from outside.
Got it. Internal and external.
Right. He also mentions threats. These are those low probability, high impact events like a natural disaster or a major lawsuit.
Okay, so those are the big ones, the ones you hope never happen.
Exactly.
Now, a key concept for evaluating those future investments is this idea of the time value of money.
It's a fundamental principle in finance that states a dollar today is worth more than a dollar tomorrow.
Because you can invest it today.
Exactly. Idelson explains present value, which is the value today of a future sum of money, and future value, the value of an investment at a specific point in the future. And interest rates, or discount rates, are a key factor in those calculations.
So when you're thinking about spending money now for a return later, you have to factor in that future money isn't worth as much in today's terms.
Precisely. And this leads us to net present value, or NPV, a crucial tool for capital budgeting, which is making those decisions about long-term investments. NPV calculates the present value of all expected future cash flows from an investment minus the present value of all expected cash outflows.
Okay.
If that NPV is positive, it indicates that the investment is likely to create value for the company.
Okay, so that's a good sign.
It is. Idelson also mentions internal rate of return, or IRR, but NPV is generally considered more reliable.
Okay, so NPV is the gold standard.
Pretty much.
Okay, let's bring this back to Appleseed. How do they apply these concepts to their expansion plans?
They're considering two main paths: increasing their applesauce production or entering the potato chip market.
Okay, two very different options.
They are. To make an informed decision, they'd need to develop projected cash flow statements for each option, estimating future revenues and expenses. Then, using an appropriate discount rate, they'd calculate the NPV for each. The higher NPV would be the more attractive option financially.
You run the numbers, compare the NPVs, and see which one looks better.
Exactly. They'd also need to figure out how to fund those expansions, which could involve debt or equity financing.
Right, raising capital. Idelson talks about the cost of capital, the weighted average cost of capital, and how selling equity dilutes ownership for existing shareholders.
That's right.
He actually provides a table comparing buying an existing chip company, Chips R.Us., versus building a new factory.
He does.
What was the verdict?
The analysis showed that buying Chips R.Us. had a higher NPV and a lowest cumulative cash requirement, meaning it was less likely to put a strain on their cash reserves.
So, based purely on the numbers, buying that existing company looked like the smarter move.
It did.
What about the accounting involved in acquiring another company like Chips R.Us.?
Chapter 22 touches on that. The acquiring company has to allocate the purchase price to those identifiable tangible and intangible assets they acquire, and any liabilities they assume based on fair values. Any excess of the purchase price over those identifiable net assets is recorded as goodwill.
Goodwill, that intangible but potentially valuable asset. This whole expansion discussion really highlights how this financial knowledge we've been talking about is crucial for those strategic decisions.
It is. You can't make those big decisions without understanding these concepts.
All right, let's briefly touch on Section F, which includes infamous ways to lose money and those appendices. Infamous ways to lose money sounds intriguing.
It is. It's a cautionary chapter reminding us of how individuals and companies have lost money through things like Ponzi schemes, speculative bubbles, and good old-fashioned fraud.
Those cautionary tales.
They are. The takeaway.